Hey guys, how you doing? Sean Taggy here, Chief Operating Officer and partner of Memphis Investment Properties, where we flip around this year around 350 single-family turnkey properties a year in Memphis, Tennessee. It is a great alternative investment to the stock market or any other financial means, and what I believe, in my opinion, is the best investment vehicle out there. So one of the reasons why real estate is one of the best investment vehicles out there is what is a refinance. So you can actually refinance this investment vehicle. Can't do that too much with any other investment avenue, and especially what's awesome is some other great tax advantages that I will get into for you later. Okay, so I'm going to pull out my phone, my little simple calculator here, and kind of just go over the basics of what is a refinance. So first, let's just start in the beginning, okay? You buy a property. Let's say you get a $100,000 loan on a property, and with our turnkey properties, they're probably going to be cash flowing pretty good, $100 to $200 a month, so you're already having cash flow. Let's forget about cash flow though, put that up on the table, and just look at our equity that's being built in this. Right, so you're going to have your amortization schedule on your loan. You're going to be paying down a little bit of principal over the years. So let's say in 5 years, this property goes up in value, right? So let's say you bought it for 120K, years 1, 2, 3, 4, 5. All right, so let's just put on a 5% appreciation, so 120,000 times 1.05, right? You got to times it by times 1.05, oops. All right, so it's going to be worth 126. Times 1.05, it's going to be worth 132.3 times 1.05, it's going to be worth 138 on year 3, and then it's going to be worth 145,860, and then on year 5, 153. That was interesting. My guess in my head, I was going to put 150, so pretty close there. Okay, so it's paid up. Then what's awesome is this will get paid down. Now I don't have an amortization schedule, but let's just call it 92,000. Okay, your loan gets paid down a little bit as well as you're paying your loan payments. Which, who's paying that? Who are paying those loan payments? Is it you? No, it's your tenant from the rent is paying that loan, paying that mortgage down, right? Probably a $600 a month mortgage or so. So a little bit of that principal is going down to this principal pay down. All right, so now what's really cool is your loan goes down, but the value, right, starts to go up. And this delta here, the value minus your loan, is called your equity, right, over the years. 0, 1, 2, 3, 4, 5. All right, so when this is big enough, you can now do a refinance, okay? So there's a couple things you can do with a refinance. There's one that's called a rate and term refi. Refi is short for refinance. Meaning, let's say this loan was back when interest rates were really high. Let's say it was a 6% interest rate, or 7. I mean, 6 isn't really that much compared to historical values, but in today's market it is pretty high. You could just refinance this 92, a rate and term, and refinance it to, I don't know, 4% or something like that. So that's called a rate and term. So you're not pulling any money out, you just have the same loan amount of what it currently is at that current time, but you just lock it up for another 30 years, but at a different interest rate. So your principal and interest payment would go down. Who knows? And this might increase your cash flow $50, $100 a month. So that's pretty awesome. Me personally, I don't really think that's worth it too much to do because there are some costs associated with refinancing. You have to pay for an appraisal, that's $400 to $700. Title fees, refinancing, lender fees, insurance, title insurance fees. I think it would be a few $1,000s. You can go consult with a lender and get all of that, and the title company and the appraiser and all that. Any of our preferred lenders would be able to get you that. I don't think this is the best either because you're going to start over again. I'm going to write in loan here. you're going to start all over again on your amortization schedule. Usually it starts that 30-year am all over again, and the first few years are usually the worst part of that principal paydown. So personally, unless there's some awesome deal or some juice in there, I don't think that's the best. But another refinance I think is amazing is called a cash out refinance. Okay, so this one is awesome. Now, it depends on the lender and their terms, and this changes according to Fannie, Freddie Mae, guidelines on refinancing. Talk to your lenders, but typically, historically, it's been you can cash out up to 75% of the value. Okay, so we're going to use this example. Let's say you go in and your property appraises for $153,000. Okay. So, you go, get an appraisal, work your docs with your lender, you qualify. 153, so they can give you a loan amount of 75% of that. So you take 153, times it by 0.75, you get $114,750. Okay, now you're not getting all of that. Why are you not getting all of that? Because you still have a loan. You still have a current loan that's paid down a little from when you originally bought it to 92, unless you bought it cash. If you bought it cash and you have no loan, yeah, you get that. So that's also another thing. That's a cash out refinance. If you bought it cash, you could refinance day number 2 actually after you bought it, if you bought it for $120,000 cash. Anyways, let's say you do still have this loan, so you would just take that $92,000 and minus it from that. So minus 92. All right, I'm going to write it over here. Cash out, $22,750. Okay, now not all of this will come into your pocket. There are some closing costs and all those lender fees. Let's call it $3,000. So anyways, let's call it just 19,000 or so is what you'll be able to pull out. And here's what's awesome is you bought it, right? You purchased it, let's say theoretically for 120-ish, 120K-ish, okay, and you put $20,000 down. All right, so you're pulling out almost exactly what you put in. Does that sound pretty awesome? Yeah, you get all your original capital. So basically you own a house for free now after 5 years, plus you've been cash flowing. There's all been these great tax advantages. Here is another awesome part about this is tax-free. Consult with your accountant, CPA. The tax laws change all the time. But historically, for a long time, this has been tax-free. Yeah, pretty amazing because you're getting a loan. You're not selling. It's not a capital gains tax or anything like that. So now you can go invest this. This is, if you sold or whatever, you would be charged 20, depending on what the capital gains tax is in your tax bracket, 10, 20, 25%, wherever the capital gains taxes are going. Okay? So it is a good alternative if you find another great deal and you want to put another 20 grand down, you don't have it right now. And so now you get, from your seed equity, you now have 2 houses. And I do this a lot myself. I'm kind of younger, I'm in my growth phase, and I would rather have 2 properties, right, appreciating 5% a year than 1 property that just has equity sitting there, because I'm still cash flowing the same and all of that. So that's a thought there. Also, depending on how much equity and where you're at and what other deals you have available for you, you could sell too, right? So this is kind of now that debate. Do I go ahead and sell or do I cash out refinance? Well, you got to also consider if you sold, yeah, you actually have a lot more equity, right? You have 153 to 192, 60 grand in equity, 61,000 in equity. So you would get 61,000 out. So you're like, Sean, I would rather have 61,000 to invest. I could go buy 3 houses instead of 2 with this cash out refinance. But you're going to be taxed, right? So you need to consult your accountant and consider what would be the taxes on that. Call it 20%, 61 times 0.2, minus 12,000 from that, okay? So minus 61, so 48 or so would really what you would have. So that'd probably barely squeeze by with 2 houses. And then also you've already spent a one-time fee on closing costs and all that to get this property. So, I mean, there's a lot to consider in here, but I've reworked the math several times in my head. I'm an engineer, done the Excels. Most of the time it is better for a cash out refi, unless, yet again, going off on some deeper things here, but you also could consider a 1031 exchange, then all those are tax deferred. Okay, so we're getting into some advanced and considerations and tax strategies here. But lastly, that is what a refinance is. It's basically using an asset, a real estate asset that you have in real estate terms, and restructuring the debt. Whether it is just the terms of the debt, you could also change your on a rate and term, you could change it from a 15-year to a 30-year amortized, or vice versa, or anything in between. The interest rates, other things like that, and also, of course, there's the cash out refinance end of it. So lots of things to consider. It depends on your investment strategies, your aggressiveness, if you have more deals to buy, where you're going to place them, if you can buy it within the realm of the 1031 exchange. But to me, I think this is a safe bet. It takes a lot of chips off the table, you know, or you just cash out refi and you have your 19 grand and keep that as a reserve fund. Just things to consider. Or you know, there's lots of things. Or you could refinance and use that to pay off one property all the way. When I'm more in my older years, you know, 50, 60, I will start eventually focusing on just debt reduction. Right now, I want as much debt because, you know, I'm growing and building my value here, and that's a hedged against inflation. But, you know, maybe a strategy would be just to refinance one to pay off one all the way. I've seen people do that. I've seen people sell one to pay off a couple others so they're owned free and clear. I think the worst thing, though, I think kind of the riskiest point of the game, though, is for you, is when you have a lot of equity. Like, let's say you're on the 30-year tail end of this amortization scale, year 25, and you have, let's say you have a $20,000 loan on a property, okay, but your property's worth 200 grand or 250 grand. You have very little loan to value there, right? A loan, that's called a loan to value. And if you stop making payments on that property, you know, you run into financial trouble. I mean, yeah, you can go and fire sell it for 150 grand or something, but I mean, that lender would more likely foreclose on you than if you have, you know, just barely any equity at the beginning. They're going to work something out with you. Those are just my thoughts, my opinion there. But that's kind of why I also keep restructuring debt, is to actually put more risk onto the lender than onto myself in kind of a way, and then just have reserves funds built up. Those are my thoughts. Thanks so much, guys. And that is what is a refinance, rate and term, and a cash out. Several others out there as well. Thank you so much. Subscribe to our YouTube channel. Make sure to check us out. We'll put out lots of videos like this. Thank you.